Good day, everyone. Today we'll be presenting the non-GAAP measures as it relates to regulations. My name is Sushma, and accompanying me today would be Jan, Isra'a, and Dalia. Welcome. In today's agenda, we'll be talking about the introduction, GAAP versus non-GAAP, a summary of the assigned and additional articles, connections to the course topics, and a brief summary at the end. As we all know, GAAP is known as a common set of accounting rules, standards, and practices. It is required that public and some private firms follow these GAAP standards. And the purpose of using GAAP is to enhance the clarity and consistency of the financial statements. However, it is found that some of the users or investors of those financial statements find that firms that follow the GAAP rules, it does not fully capture the firm's performances and values. As for the non-GAAP measures, it provides more detailed information about the firm. It removes elements that deem to be temporary, uncontrollable, or irrelevant to the user. The goal is to simplify the user's understanding about the financial statement. Some of the example is adjusted earnings per share, adjusted net income, and EBIT. Some of the non-GAAP measures issues is that contrary to GAAP, the main issue with the non-GAAP method is that they do not have a reporting standard, and that makes it unaudited. It's therefore difficult to compare, thus making it more susceptible to manipulate the information in the financial statement.
Hello, today I will be talking about two articles, one Good by Performer Earnings, and the other one SEC adopts rules for non-GAAP informations. So the first article I will be talking about is Good by Performer Earnings. So after reading this article, Good by Performer Earnings, it stated that on March 28, 2003, the last and final rule was created in order to make regulations which required all public disclosures making standard for their disclosures as well as discussing what the non-GAAP financial measures are. However, this article mentioned how when it comes to Securities and Exchange Commissions, which is also known to be SEC, filling them have extra limitations when it comes for the non-GAAP financial measures, and these limitations are given risen over GAAP numbers. An example of this that businesses cannot talk about non-GAAP topics while only offering GAAP figures. And second, take away not included any liabilities or charges that could potentially include cash settlements. 3. Eliminate items that are deemed or unusual. For example, many companies tend to exclude restriction price and put it as a reconciling item. And last but not least, 4. Not allowed to use the same GAAP title. An example that they had mentioned is that operating income and operating earnings are very similar, so you cannot use that. With this being said, there has been new rule that mentioned that earnings need to be recorded and filed with SEC as an item 12 of 8K form and only given 5 days from the release that was made publicly on whether or not they should include GAAP. Not only that, but past SEC that were issued requires that if any private disclosures were made, that they would now have to make them public. Overall, the reason why this new rule was made when non-GAAP requirements are used is because this provides investors with balanced and meaningful disclosures, as well as not having any random information. Doing this will allow more detailed, more prepared, and well presented so that there will not be any incorrect or misleading earnings that have been released. My second article that I will be talking about is SEC adopts rules for non-GAAP information. In this article, it talks about how back in 1990 to 2000, there was a large number of companies who were unhappy who have been decided to have adjusted operating results. Having adjusted operating results removed all unusual similar products and expenses. Later on, the U.S. Congress made the SEC get comfortable with the rules, in which they had to accommodate any pro forma statement that they had and put it under GAAP. Doing this could have caused more negative aspects than positive. A negative aspect is that it is not clear if the GAAP financial statements are needed for investors rather than having the non-GAAP financial statements. With this being said, the new rule was mentioned above does not prohibit the use of other GAAP financial statements. However, more specifically, it does not prohibit the EBITDA disclosure. If a company was disclosed EBITDA, they would have to disclose cash flows from other operations as well that are measured by GAAP. Furthermore, EBITDA is known to be an example of non-GAAP measures, which seems to be very important to the investment group. Saying this, information such as comparative results or core operations are needed when you are disclosing with EBITDA. Lastly, EBITDA and other very important GAAP measures are not subject to the rules that are given by GAAP. Many companies and businesses are allowed to calculate the GAAP measures in different ways. This makes companies' disclosures regarding specific GAAP measures not similar. Therefore, by doing this, it will be really hard to see how the new SEC rule will remove these rules or any other rules that regard the GAAP measures calculations. Thank you for listening, and now I will be passing it on to my other team member.
According to the article, SEC proposed new Regulation G on non-GAAP financials. This regulation would stipulate that firms disclose any amounts subjected to adjustments that would have been excluded in the GAAP measures. The new regulation would also prohibit any material misstatements or omissions that would make the representation of the non-GAAP measures misleading. The proposed new regulation would require firms to disclose material off-balance sheet transactions, arrangements, and contingent obligations on their quarterly and annual financial statements. Also, some of the other items that will be reported under the new regulations under non-GAAP measures include those material items that could have current or future effect on the firm's financials, such as capital expenditures, liquidity, etc. These transactions would need to be recorded under the management's discussion on the financial statement.
This article examines how over the past decades, earnings based on GAAP measures have shifted and became a more noisier measure of determining economic income. Managers and investors have shifted their focus away from GAAP measures towards an alternative earnings performance measure that measures the core earnings. These alternative measures have proven to be more valued and are more relevant for companies as opposed to GAAP measures. In the beginning, using non-GAAP measures was concerning because of the many misuse incidents that occurred. After that, the U.S. Congress ordered the CEC to issue new regulations to regulate the use of pro forma earnings. Later on, CEC established Section 401(b) for the reporting of non-GAAP measures, requiring managers to reconcile earning figures to the most directly comparable GAAP measure. The article further examines the effects of intensified scrutiny due to non-GAAP earnings on the quality of reporting. The article claims that non-GAAP reporting brings in more quality exclusions. It had found that exclusions are of a higher quality for firms who reported after the CEC interfered into non-GAAP reporting, and fewer quality exclusions for firms who stopped their non-GAAP reporting after CEC's implementation.
According to the article, the impact of the SEC's regulation on non-GAAP disclosure, it is common that managers will claim non-GAAP earnings disclosures to convey their permanent earnings. There is a concern that some managers use non-GAAP earnings as an opportunity to represent their own performance. Therefore, the new rule outlined that if a firm discloses any earnings using non-GAAP measures, they are also required to do the following, which includes disclose any reconciliation of any non-GAAP numbers to the GAAP numbers, and disclose the most directly comparable GAAP earning numbers. However, one of the major impact is that the new regulation affect both the opportunistic and non-opportunistic non-GAAP disclosures, as it is required that reconciliations be more transparent, and it can be costly as firms will have to absorb those costs when disclosing information to investors.
The Securities and Exchange Commission's Regulation G addresses public companies' disclosure or release of information that is not calculated or presented in accordance with GAAP. The CEC's Regulation G says that any company releasing non-GAAP financial information must include a presentation of the most directly comparable GAAP financial measure and a reconciliation of the disclosed non-GAAP financials. So what are the impacts of Regulation G? After the CEC implemented Regulation G, there was a decrease in non-GAAP reporting. Regulation G also reduced opportunistic behaviors. While the outcome of Regulation G results in an improved quality of information and pro forma reporting, this is done by discouraging opportunistic opportunities of pro forma reporting.
Now, moving on to the SEC regulations G, S2B, and S2K reporting non-GAAP financial measures. In an effort to enhance disclosures still further, the SEC in implementing Section 401B of the Sarbanes-Oxley Act has actually addressed the issue of pro forma financial measures. So the SEC has just adopted Regulation G, in which it deals with non-GAAP measures in financial reporting. This regulation mandates a reconciliation of non-GAAP to GAAP measures in all public announcements, including press releases and other forms of communication, which could effectively reduce the use of non-GAAP measures in business communications. Regulation G does not apply to disclosures of non-GAAP financial measures constituting the forecasted results of a proposed business combination, nor to the entity stemming from the combination, nor to a party to the business combination. Examples of non-GAAP earnings measures include operating earnings per share, pro forma earnings per share, income excluding restricting charges, and EBIT excluding non-occurring charges. Now, excluded from non-GAAP measures would be such items as ratios computed on the basis of GAAP. Examples of non-GAAP earnings measures include operating earnings per share, pro forma earnings per share, income excluding restricting charges, and EBIT excluding non-occurring charges. Now, excluded from non-GAAP measures would be such items as ratios computed on the basis of GAAP. Examples of non-GAAP earnings measures include operating earnings per share, pro forma earnings per share, income excluding restricting charges, and EBIT excluding non-occurring charges. Now, excluded from non-GAAP measures would be such items as ratios computed on the basis of GAAP. Now, in companion regulations, the SEC has released an amendment to Item 10 of both regulations, S2K and S2B, that deals with non-GAAP measures in SEC reporting. Now, the same definitions in Regulation G apply here. However, the requirements for regulations S2K and S2B call not only for reconciling the non-GAAP financial measures to its most directly comparable GAAP measure, but also for presenting it with at least as much prominence as its non-GAAP counterpart, and for explaining why the non-GAAP financial measure provides useful information. In addition, regulations S2K and S2B prohibit companies from the following actions, reflecting in non-GAAP measures that exclusion of items reported as non-occurring, occasional, or usual, reporting non-GAAP financial measures in the GAAP financial statements themselves, and using titles of not financial measures that are similar to titles of GAAP financial measures. In fact, regulations G, S2B, and S2K do not require reconciliation of non-GAAP forward-looking measures to their GAAP counterparts if the forward-looking measures can be obtained with only unreasonable effort. Now, the rationale of these new requirements to reconcile GAAP numbers to non-GAAP figures is actually to promote truthful financial disclosures to the public in plain English. Since in the recent past, too many high-profile companies have used non-GAAP measures to obscure their GAAP performance, especially in corporate press releases and other announcements.
In relation to our course topics regarding information asymmetry, Firms would take advantage of information to improve their performance, have the ability to control net income by performing revenue reconciliation, which allows performance goal bonuses to be tax deductible. Having the non-GAAP measure will increase investors' interest in the firm's performance and maintain market efficiency, as all parties will have access to the same information. In relation to full disclosures and regulations, the Regulation G stipulates that firms should not disclose information that would mislead investors. They are required to disclose any differences in numbers between the GAAP and non-GAAP numbers, and all information should be relevant and reliable to the investors. As for reporting quality, restricted regulations as non-GAAP measures are unaudited. Regulation G will improve the information quality in the pro forma reporting. This regulation will discourage opportunistic managers from manipulating information. Regarding market efficiency, the SEC regulation would ensure that firms disclose all relevant information to investors, have an impact on the share price, and investors will have a better understanding on the firm's performance. They will also have the ability to predict the future performance of the firm and have better interpretation of the information to make a more informed decision. As for the earnings forecast, transparency in the financial information used in the SEC regulations is important. Stricter regulations to avoid any information misrepresentation and ensure that all relevant information are disclosed to avoid any information asymmetry in the firm's earnings.
To sum up everything that has been stated so far in the presentation in regard to companies' use of non-GAAP measures, while the main purpose of reconciling numbers to non-GAAP is to promote truthful financial disclosures. However, many high-profile companies use non-GAAP to obscure their GAAP performance in corporate press releases. As seen in the presentation, the regulations as it relates to the non-GAAP measures and how it affects companies. One has to wonder why the SEC decided not to prohibit non-GAAP measures entirely. While the SEC's allowance of pro forma earnings evidently indicates that such measures have some validity, perhaps in assisting investors to determine recurring income figures. And it remains to be seen to what extent these regulations will curb use of pro forma figures in corporate communication of all kinds,